Hello, everybody. I'm your boss, Joe Boss, and welcome to another weekly plan. We got some particularly crazy moves into the end of last week. We got some more Bank of Japan intervention, Ministry of Finance, and we got some general risk-on moves across the board, even in equities. Check that out. Nice recovery into the end. If we check out the DXY, it's fallen, and has this big bottom wick. Now, I'm going to do a little PSA. Chart patterns lie. They lie a lot. Just because this thing has a big bottom wick on it doesn't mean this thing's going to reverse. So what we're going to do in today's stream is we're going to look over some statistics. We're going to look at tools that I've built to get those statistics, and we're going to use them to come up with some sort of expectation for the week ahead. However, after reviewing some outlooks for the week ahead here, and this is the economic calendar on the right, but I also have something else here. Ah, yes. These are my Outlook notes. So what I do, I have about 40 pages of notes here. And if you're in the trading group, you'll get access to this. But I'll just share the summary here for all you guys to kind of see what's offered in the trading group. Also, we got this little thing here. BOJ saw Powell presser and said, all in with no hesitation, referring to JPY. I mean, look at this thing. Absolutely nutty. From high to low, it fell about 800 pips, close to 1,000 pips. Yeah, 837 pips from high to low. Absolutely insane. So when we see here all in with no hesitation, yeah, what's really interesting here, in my opinion, is that the yield spreads have started to go negative, and you can see that with the indication of this red highlighted candle. These green bars are yield spreads, and these are the actual values of those yield spreads. Essentially, it's just taking the difference between yields in the United States and yields in Japan, and you can see that the yields in the United States have been falling faster, and that the yields in Japan have been either staying relatively the same or increasing. So when the spread, the difference between the yields in the United States and Japan get shorter and tighter, this turns red. And when they get further apart, this turns green. And this works in replay mode too. So you can see here like all this positive yield spread, and you can even look back here. Look how clean that looks, right? All this red. This is better than any momentum indicator, that's for sure. I mean, momentum indicators can get quite choppy around these sort of pullback ups, and they say, hey, you know, now it's time to get out. For FX, yield spreads are really nice. Anyways, yeah, green up, red down, green up, red down, green up, red, and it just went sideways, and then green up, and if we fast forward to today, green, 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 and then on the day of the intervention, the yields flipped. They went neutral. And then you had this wonky day here, another set of intervention, another flip, and then follow through on the red. So today's stream is labeled The Yields Amazing. What do they mean? And the big problem I have with these outlooks, mostly for the week ahead, and actually some of the statistics that we'll be looking at, is just, guys, these yields are looking really risk on here. Like, my expectation for most of May was just to see the US dollar get stronger and stronger and stronger up until like the end of the second week of May, maybe into the third week of May. And then, we get maybe risk on from there, depending on how the economic data turns out in July. But now, let's just start off with euro dollar. Then you can kind of see what I mean here. I don't know what about. Have you guys been seeing TradingView taking longer and longer to load? Anyways, we got a flip here, right? Huge negative yield spreads. And if I turn on my drawings, you can see I've been nailing expectations here for the last while. This was a bit of an overshoot, but that was nutty. That was nutty. And I got that trade, and I got this trade currently on. I hit that one, this has been pretty straightforward. But I'm not here to show okay, things I have set good expectations here, and you can kind of see the accuracy of my expectations by looking at these drawings and these rectangles. But I'm kind of concerned looking at these yield spreads, and I look at the odds for next week and I see, oh, these are really positive yield spreads. But when I look at the high, for example, on euro dollar for next week, it's like, well, most of the time your high looks something along these lines. If I could, yeah, it looks something like this. You go up into around here, and we can use the range probabilities to set a more precise shot. So somewhere maybe around here, or on a really good day, it goes all the way up into there. Yeah. Somewhere around here, call it in the 108, 108.2 mark, somewhere around here. And the markets do open in about 45 minutes from now, so when the chart updates, we will be getting, we'll still have exactly the same drawings. So don't worry, when this chart updates, all these drawings that we're looking at for the next period will stay exactly the same. It's just everything gets shifted over one bar. And I'm looking at this and I'm like, okay, yeah, sure. But if these yield spreads stay incredibly positive, I wouldn't be surprised to see us move much higher. And I don't want to lead you guys on for too long. I'm going to be looking at some monthly targets in the stream. This is a weekly plan stream. But as I started looking through the calendar, and I can bring up the calendar right. As I started going through this calendar, I'm like, well, for this week, pretty much. And you can see I started looking like 2-3 weeks ahead. And I'm like, dude, this is really looking risk on to me when I look at this calendar. Anyways, let's see. We want to look at Monday here. Yeah. Look, right off the bat, as we get into the week ahead, PMIs, the final PMIs come out. We had the flash PMIs come out, and those were gangbusters. Those absolutely killed it. And now we're getting composite and services PMIs coming out. And look at the consensus numbers. These are all really close to or getting definitively into the 50 zone, which is growth. Compare that to recently how the US just had its own services PMI fall below 50. So there's a problem here. US inflation can stay sticky, and its growth is falling, and the employment side is falling, while we're seeing essentially the opposite occur in a lot of G7 countries. Not every G7 country, but in a lot of them, especially in a lot of places in Europe. So, as a guy who likes the idea of the dollar smile theory, I'm thinking oh man, um, this is kind of a tricky spot because the United States isn't doing great, but the rest of the world is doing okay. This puts you kind of in the bottom of the smile, in the sweet spot for the dollar to get weaker from here. Not only that, but if these yields on the US side against the rest of the world continue to, I mean, just look at this. This is pretty good improvement. Also, look at this spread 3 over here, negative 0.887. If we just go to 3 or 2 days before, like over here, this was at negative 1.72. You go forward 3 days, and now it's in a much better position, these longer term yields. Essentially, this huge move is getting kicked out of the window shortly here. Yeah, by the end of next week, this whole section here gets kicked out of the window. And all of these shorter term yields will probably be above the longer term one. And if the economic data of the United States doesn't, pick up and stay strong, this could be unexpectedly more risk on than people actually expect, even more than I expected. And I'm looking at these outlooks. I'm looking at these expectations, and I kind of find it hard to disagree. Like, okay, we would expect the United States dollar to get stronger, but we're just not seeing the weakness in the rest of the world that would put the US dollar in like a position of best of the worst, right? Which is kind of where we've been at with US dollar strength for, frankly, a while, since the beginning of the year, essentially. Outside of this run right here, and also as a little tidbit, check that out. We had negative yields. Economic data improved from here, and then we got the next round of economic data of the United States doing really well. And it's around this time here, too, that the expectation for Fed rate cuts, essentially like we were expecting 3 or 4 Fed rate cuts, and then that got slashed down to like 2 or 1. And right now, at this day here, it's still 2 or 1, but it was getting closer to 1 than it was 2. And when you go and you read outlooks from these institutions, they're still saying stuff along the lines of, oh, we're still expecting 2 to 3 cuts. Like, what? Especially if these yields on the US side remain high. I mean, look, these US yields are in a really tricky location. I am very, very, very carefully watching this particular indicator more than over the next week than the seasonality stuff here, right? You can see the seasonal expected move for the next month on this pair here is red, 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 red. I mean, sure, that's helpful, but this might not necessarily be the point in time to start looking at seasonal data when this data might not be behaving seasonally, if you get what I'm saying here. Let's go ahead, bring up... Oh yeah, I wanted to bring up these monthly spots here. So what we've gone up so far, we can probably go a tad bit higher. I do wish this thing would update. That is a slight little... This thing needs to be down to around there. That is a slight little bug. Just during off-hours season. It does that at the moment. Let's go ahead and look at our lows here. And again, a lot of lows are down here. Either this thing, these yields are going to start to flip and we get some good economic surprises out of the United States, or some bad economic surprises out of the rest of the world, and we do go to, the 105 spot, which is when I did my month ahead expectation, this is what I was expecting. And I was actually expecting these yields to get even worse. But now the possibility of the Fed actually cutting 2 to 3 times this year can be a possibility. More people are open to the idea. But I do have one little quarrel with it. And it's that understand that when we look at employment figures here, let me go ahead and bring up the economic data. Let's see here, jobs, wages, week ahead. Yeah, jobs growth. Look at this. Here, let's look at the last. I wish I could set a custom time. So let's look at first pre-COVID. Pre-COVID, we were getting around 200K jobs a month. Somewhere between 150 to 250,000. That seems to be around the ballpark. And now today we're at the high end of that range. We're like around 150 to 300K. So the long-term view is roughly 200K, and we're more or less averaging 250K right now. So to see this number fall is normalization, technically speaking. I'm not freaking out about jobs growth returning back to its long-term value. So I think there's a bit of overestimation around the labor market. And I don't think that the Fed is going to actually be terribly concerned about this unless we start seeing like 100K or sub 100K prints come here in the NFP. I don't think the Fed will be concerned about the labor market until then. So when I read through all these outlooks for the week ahead, I just seeing so many people putting multiple carts before their horses, whether it's on the employment side or on, oh my God, I'm going to start expecting 4 rate cuts side. Like there's some headlines accusing JP Morgan of forecasting 8% cash rate, saying that we're going to hike higher and higher and that yields are going to go higher and higher, which, you know, we could go higher on the yields. I haven't ruled that out, to be frank. In all seriousness, what I'm trying to convey here is that there's a lot of uncertainty. I mean, you guys, if you've been trading the last couple of weeks, you know that we've essentially been bouncing up and down in these markets because people don't know whether or not to expect 1 or 0 or 2 rate hikes out of the Fed. Like, we're pretty certain of what other central banks are going to do, but we're not really certain what the Fed is going to do quite yet, because the Fed wants to see essentially what comes out during the summer. Let me go ahead and check out the chat here real quick. Go ahead and say hi if you just joined. Yeah, music is over now. New Zealand Swissy would be nice to discuss. Hi, sorry, late for join. Not a problem, my man Harold. Nice to see you, Victor. Gold. Yeah, we will actually check out gold in a little bit. We're going to go through the FX and then the commodities. So just to kind of round up my thoughts, the reason why the stream is titled the way it is because I am on edge right now. Data can get easily misconstrued, bullish or bearish right now. there's a big polarization right now, depending on who you ask. And not only that, but they're also polarized over different time horizons. Some people are like, okay, dollar is going to get strong over the next week, and then it's going to get weaker into the summer. And some people have exactly the opposite view. So all I'm saying is I'm going to be extraordinarily careful here. I'm going to be extremely reactive. And while if I just look at the odds for next week, looking at things seasonally, they tell me that the dollar should be getting stronger here. I look at these yield spreads and I say, I need these things to flip here. I need these yield spreads to flip bearish or more neutral before I, consider some sort of significant short for essentially 130 pips over the next week. I need something more significant than, oh, you gave me a candle with a really tall top wick here. And when I look at the data just coming out in the next 24 hours here, that could be really good for risk on. The euro could move more positively. I mean, oh my God, the Bank of Japan could intervene again, right? There was a lot of people who got long right around here. If I go to like a 2-hour chart, you can see right here at the bottom of that wick. And boy, did they get rammed. And these yield spreads are still quite negative, still short term. And if you trade pivots, these are super expanded pivots. The volatility for the next week just makes trying to do predictions really, really hard. But I've been laying off doing, like you can see, I was doing pretty consistent on my expectations. And then during this week, I stopped setting expectations. I stopped doing my drawings because I'm like, dude, the BOJ is going to intervene any minute. And we're essentially playing chicken with our portfolios, trading this thing. And I'm, glad I stopped from setting expectations on this. But you can see yield spread started to increase going into this week. They got super choppy here. Almost had a failed intervention here. I did set an expectation that after we had this dump, we'd go to 158, and we got like 6 pips off. So, within a margin of error, good hit. And then they intervened again. And now it seems like the market's like, okay, you win. You win, Ministry of Finance. You win, Japan. And I think after this next week plays out, we could probably start setting expectations again. So a month without being able to set expectations on this thing due to, market interventions. But it's this type of stepping away that can really save your butt. Then again, being long this was 400 pips, but Lord, hopefully anyone who was trading short on this thing had good stops or enough liquidity, depending on when they were trying to enter their longs or their shorts. Not a fun time trading this for a lot of people that I've talked to recently. Not a fun time. 'Tis the life of retail FX. So, requests before I just start going down the watch list here. I do see yours there, Trading Spot, New Zealand, Swissy, and also thank you for posting that in the Discord. This one does have quite significant negative yield spreads here. And it looks like I already did the week ahead trade plan on this over here. Yeah. And I think we're going to probably stick with this expectation on the New Zealand Swissy. Yeah, so maybe it goes a little bit higher, somewhere around the top of this wick. Yeah, I wouldn't be surprised to see that. I really wonder what's going on with the Swissy here. Yeah, you can see negative yield spreads coming on in. Yeah, so the yields in Switzerland seem to be improving. They seem to be improving. Surely the BOJ has been found spineless by letting it go so far beyond expectations. The invention is just a temporary thing. Pause. They will intervene again if they have to. Bank of Japan and Ministry of Finance, they got enough money in reserves, and they haven't even tapped into treasuries quite yet. From what I understand, they are selling dollars or buying yen at the spot market. They're not necessarily intervening in the yields directly. Maybe they are a bit. I haven't looked into it too dramatically. But the move in the yen has pushed US yields lower. And as we get somewhat weaker US economic growth, somewhat weaker US employment, and potentially worsening services and manufacturing PMIs out of the United States, and then all those things relative to every single other G7 country, you could see a period of risk on that a lot of people weren't expecting. I'm going to stay highly reflexive going into in all seriousness, like not just this next week, but the next couple of weeks, in my opinion. I'm just thinking from the perspective of what Switzerland did in 15, get protection. Yeah. Let's check that one out. Euro Swissy. Yeah. Looks like Swiss franc is doing pretty good right now. It looks like it's gonna bounce up to here. Those are some pretty high odds of going higher. So let's see here. Yeah, wow, most of the lows around here, and that's a big probability gap right there next week. Let's go ahead and draw that one up. 505, right? Yeah. And then up like that. But it might be more like this because we're getting those PMIs coming out for Europe right at essentially on Monday. Let's go ahead and timestamp that one here. Sorry if it wasn't clear. 15 January. No, that's all good, Harold. Thank you very much, my man. And Victor, I think you've been patient here. I'll go ahead and bring up gold in the meantime. I believe we look at the gold futures contracts. Yeah. Well, we had bearish expectations around here, and then for the month, we set more bullish expectations. That's what these ones marked for the 28th were. So we were expecting the high for the month to be around here, and then for it to fall lower. There's probably some kind of move lower here. I think the volatility in gold is going to be relatively flat. It seems like the volatility compared from this week to this week to this area over here, the volatility does seem to be thinning out a little bit. So maybe a more or less range bound. I could be wrong. This could be up and then down, or down and then up. It's either way, in my opinion, at this point in time. But I'm expecting this thing to be pretty much range bound. And if we look at this, yeah, all well and good. So nothing crazy as far as expectations go on the gold side of things. There are people saying that there's been a lot more speculation of gold going higher. And if you do get some dollar weakening, if that risk on movement comes through, if yields do start to fall significantly in the United States for whatever reason, maybe another rate cut does get priced in. We do have Fed speeches over the next week, guys. Let me go ahead and pull this up real quick. Okay, so this is next week here. And if we look through, that's BOE. Yeah, Kashkari speaks. Jefferson on the next day. So not a whole lot of Fed speakers. Summary of opinions will be interesting. And then I believe, what is it? There's a really big day for the pound. Yeah, and then we have jobless claims here. Consensus is that it's going to stay elevated, which is not great, frankly. Okay, current account. Yeah, and then here's all your UK stuff. This is probably going to end up moving the pound. And then on Friday, here's another Fed speech. And then University of Michigan stuff. If the University of Michigan inflation expectations value does come in lower, I would actually expect there to be a weaker dollar off that move. There was some commentary saying that the Fed started talking about inflation expectations again. So we have to look at this event as potentially having a bit more significance this time around than it has over the last few months as far as inflation expectations are going. Because if this number starts to go down, inflation expectations start to go down, the likelihood of at least 2 cuts coming through into this year. I mean, there's wild calls for like, hey, if inflation expectations come down hard enough and inflation itself comes down hard enough, or the labor market, goes and starts printing 100K on non-farm payrolls, that's gonna induce the Fed to take a more dovish stance, at least in the July meeting, if I'm not mistaken. A lot of people have really dovish expectations. The people have really, like, they're expecting over the next couple of months here, as we get into the end of the second quarter, that the Fed's going to turn dovish. But we need the data to come out and actually prove that. And all of these guys talking about trade plans and trade ideas for May, for information that we're not probably going to have until the latter half of June, makes me kind of upset, a little angry, because I know there are people reading these things that don't have, like, there's all these different dimensions so you have to take into account when it comes down to setting an expectation. There are the assumptions behind the expectation and the timing when you expect those things to happen, and then at what prices you expect those things to happen. And the assumptions are just the stuff about, like, oh, why do you think this thing is going to happen? What events are the catalyst? What's actually going to move this? Are the yields going to be the driver? Is an economic event going to be the driver? What's the operational, mechanics here economically that's actually moving this stuff? The fundamentals, if you want to say. And yeah, these guys have good assumptions, but a lot of these assumptions that I'm reading are for things that are coming towards the end of June. We'll find out about them by the end of June. And they're talking about positioning for that stuff right now. So there's a bit of a mismatch between the timing of these expectations and the reasons for these expectations and the reason for taking the trade literally right now. I mean, I flipped on euro dollar this week because I did what I said in the title of this video. It's the yields, Mason, the yields, right? I had I had this one long trade here. See how we had all this negative yield spread? It went neutral. positive yield spread, more neutral. And I set this bullish expectation based off of, and we can use this in replay mode too. We can go ahead, load this on the high side. There we go. Yeah, see, there's your probability weighted pivot. If you take all these probabilities and use those as weights against each one of these pivot point lines, you get this probability weighted pivot. And that tells you, based on the high probabilities, the probability of finding your high between any two pivots, this is where you find it. This is like the mean or the weighted average of all these probabilities and all these pivot points, condensing all the information into one spot. So I set that expectation, and that was good. And now I'm really not sold on this expectation here. I'm really not sold. These are really strong yield spreads. And when you go to the daily, these are moderately strong yield spreads, but these can improve quite rapidly and quite fast, to be frank. Especially if those the University of Michigan expected inflation expectations comes down, and we have really good PMI data here on Monday, you could just end up with this positive drift, this low volatility positive drift for the week. Let me go ahead and look at our closing odds here. Yeah, you can see a lot of closes down here and a very infrequent number of closes up here. So this is to say, most of the time you're closing like this, right? Most of your closes are along these lines, which actually would put your low a bit lower into like the middle 106s. And then you would draw this like so. I don't know. All things considered, this looks, so it'd be more or less like that. So this would be the nominal expectation. Let me go ahead and timestamp these things. This would be the nominal expectation. If we're just looking at the odds, if we're just looking at the probabilities and the tools, they say, okay, this is the expectation for the week ahead. But then I look at the economic environment and I look at these yield spreads, and then I see the risk of these yield spreads getting more and more in favor of risk on. And I'm like, all the expectations for a stronger dollar next week could quite easily get upended by just these yield spreads getting more positive. And they're already quite positive, and they are moving already in an increasing direction here. So if they continue to increase, I'm gonna stay on hold with any of these shorts. So how do we balance these risks? What's kind of the middle ground approach here? Well, my middle ground approach would be I expect this thing to go up over the first couple of days because of those manufacturing PMIs, the composite and the services PMIs that are coming out here on Monday for Europe. And so that'll probably send, Eurodollar back to the top of this wick. That is so long they don't surprise to the downside. And it'll go even further up to the 108s if they surprise to the upside, surprises. But at this point here, I want to see the yield spreads. I want to see the yield spreads reverse. Like around the 7th to 8th here of May, around here, I want to see the yield spreads actually reverse before taking any pot shots here on the downside. So while this is the nominal trade plan, and then, you can even look at this seasonal data here. All this negative expectation for all the rest of next week. But we got to be careful, because if this is not, you know, just because something happens a majority of the time doesn't mean it still means that there's a minority of the time it still doesn't happen. I know I'm being quite cautious and I'm being, but that's, when I'm going live and I'm talking to a bunch of guys on YouTube, I want to go through these nuances. I think going through these nuances is really, really important. There are assumptions behind all of these tools. There are assumptions behind all of these probabilities. And if you don't understand the assumptions behind your expectations and the tools that you're using, you don't know when they're not going to work, right? That's a problem with actually a lot of technical analysis tools and even fundamental analysis tools. The relationships that cause those tools to be good rules of thumb or whatever break down in certain situations. So it's important you understand the assumptions that go behind those rules of thumb or trading rules in whatever system are before you go ahead and pull the trigger, right? It's like when you're building, a scientific test. You don't just test a hypothesis. You have a couple of assumptions on what to expect from your hypothesis. And if that isn't met when you're doing your experimentation, or the experiment plays out completely different than you expected, you're like, well, what's going on with the process that I'm using here? Is there some assumption that I'm not taking into account in the tools that I'm using? Like a lot of guys use, standard deviation bands. That's all cool. I got something here that uses standard deviation like stuff on it. All well and good. There was an options trader for Edmund de Rothschild who used essentially this exact type of indicator system on his chart, these little bands here. And this is a free indicator. You can just search this up, boss bands. But I'm not into that. I want to have as few assumptions as possible when going into the next period. And then if I do have any sort of assumptions in the tools that I'm using, I need to make sure that those assumptions are met before I pull any triggers, right? So if you have assumptions in the tools that you're using, you have to make sure that all those assumptions, they're like requirements. You have to make sure all those requirements are met. They're like a filtering tool. But most people don't think of trading tools like that, which, gets people into a lot of trouble. It's like with CFTC data. They don't understand that the data is lagging and that it's better used as a continuation of momentum signal than it is a good reversal timing signal. Because the data is lag, you're not going to be able to catch reversals in a really timely manner unless they are like really slow reversals, if you know what I mean. So I need to add like a note or something here, a little call out. I need negative yield spreads. Let's put that there. We can make that just a wee bit smaller. I need negative yield spreads. So now I'm more happy with setting this expectation. And this pretty much applies to all the US dollar pairs. Yeah, you can see I was so happy I hopped out of this one. Oh, man. Yeah, this was a nice little call, but damn, that thing pulled back or what? And now we still have negative yield spreads here on the Canadian side of stuff. Long term, though, on this daily, the yield spreads are still holding up really strong. Yeah, Canada's not in the best of scenarios here. So maybe this is ready to go up and away. Canada is really not in the best of places, frankly, economically. Whenever you're looking at a particular currency, you can't just look at that currency in isolation like the US dollar, right? We can set these things of like, oh, we have to wait till we get these negative yield spreads on Eurodollar before Joe would like to take shots short on it. But for something like US dollar CAD, the Canadian economy, from what I see, is just so terrible. This is so bad that even with the US dollar performing, and with the US economy slowing down, the Canadian economy is already not doing great. Like they're already struggling. And with oil prices going down like this, very little support. Very, very little support. And you can see my expectations were for a more moderate fall. But then, you know what happened? Crude oil inventories surprised positive 5 million barrels. Or 7 million barrels, right? We were expecting -2 when we got, +5. So there's a 7 million barrel net difference, but a plus 5 million barrel surprise. So that was nutty, and we're probably going to be trading around here for a good little bit. Let's look at the closing odds here for the month. Yeah, it's going to be quite choppy somewhere here in the $77, $72 range, this whole $5 range. I'd say it's even Steven for figuring out the call. There are some closes down here seasonally for the month, but most of the closes kind of revert back up here to like the $80, $81 handle. It's just going to be a matter of opportunity, because if the US dollar does get weaker for whatever reason, just relative weakness on the economic front can make the US dollar weaker. If yields continue to fall on the US side, this, I would expect just a nice, smooth, little gradual curve higher. Something along those lines. And I'll pop that in as an expectation. I'm not, totally happy about this, but, just given this preliminary idea, okay, I'll go with it. We'll go ahead and timestamp these things, see how they go for the month ahead here on oil. As far as the week ahead, yeesh, this is probably going to get a little tricky here on oil, not going to lie. It does have more positive closes, though. Look at that. In the last 21 years, every single close has been above this S1.5 pivot. So maybe something more along these lines on the closing side of things. So no idea where the low exactly is going to end up. And then this brings it back to the 80 spot. So that reaches the month-end expectation super early. We'll look at month-end expectations once we get closer to the end of May. How about that? This would be my kind of net expectation. A more positive close somewhere in the 78, 79 handle here for the next week. And then if we look at our ranges, yeah, somewhere around here, 78, 79. Roughly around there. That's where we find most closes. Unless we get, production coming back online suddenly from OPEC countries or something. That would be quite a shock, actually. Now would be a good time. Anyone who wants me to look at a chart or a particular asset, to go ahead and pull it up in the chat. We got like 1 minute until the market opens. And we'll stick around for probably like 5 minutes after that, just kind of see how things move, and then call it a day. Hey guys, if seriously, if you made it this far out into the video, leave a like, please. I appreciate it. Streams have been getting a lot more viewers lately, so been really appreciative of everybody watching and everyone hanging out with me in the chat. Nice to see the chat's more alive. You know, thanks Harold and Victor and Trading Spot and Malos. Nice to see the channel doing well. Nice to see things growing. We're doing something right. We're doing something right. All right, 4 seconds. Market opens right now. And I believe Oanda takes a second to update. Yeah, was quite a massive workload. Markets have not opened quite yet here. I don't know, is today supposed to be a holiday or something? Why isn't everything opening? It's market open. It should be. Am I forgetting something today? Here, let me go ahead and check out news. No, it just seems like things are moving slow. Bank holiday here in the UK. Well, that might be it. Oh, 04. Okay, so a few more minutes. All right, then. Thanks, Richard. I appreciate that. Yeah, haven't had that happen to me before. Usually they'll, for me, I've seen them open right on the mark at 2. But I don't know, maybe today's a slow day. Yeah, so I've done streams like this before, and yeah. So that's a little interesting. But none of the other FX charts seem to be updating. Let's see here, Forex.com is open. Yeah, check that out. Forex.com is open. And so far, we've had a little bit of a green move so far. And the yield spreads are more positive. Great. So far, the yield spreads are moving. You can see the color of green here. That's a greener green than this green. Must mean more green ahead. Alrighty, everybody. Hopefully you all have enjoyed the commentary. It was a bit nitpicky today, but we're really in a transitionary period here over the next couple of weeks. So I'm going to be focusing on these yield spreads here and closely watching the economic data and how that is changing our future expectations out into, frankly, the next couple of months here, into June and July. Because a lot of how this data develops here throughout May is going to set expectations going into the end of the second quarter, potentially beginning of the third quarter. Yeah, it can make a big difference, having those expectations. So I'll go ahead and thank you all for watching. If you want access to these tools and the yield spread indicator and all that, go ahead and hop in and join the trading group. Link to that is in the description with the WAP. And leave a like, support the channel, subscribe, and all that. And I'll see you guys in a bit. I'll be streaming throughout the week, so make sure you have notifications on to know when I'm live. You can also hop into the Discord. I send out notifications when the streams start. And yeah, I'll see you all in a bit.